Well, you can't really talk about finance without starting by reference to the financial crisis, which Australia weathered better than most other countries through what might be considered a combination of good luck and good management. We didn't have a recession, and the government didn't have to use taxpayers' money to bail out any financial institutions. But the crisis did, of course, have some major immediate and ongoing consequences for the property development sector. Development finance was significantly impacted by the financial crisis, and those effects have lingered on. Some previously important sources of finance for development, including securitisation markets, effectively dried up, while other debt providers, including banks, became substantially more risk-averse, both of their own volition and at the behest of regulators, resulting in tighter lending criteria, lower loan-to-valuation requirements, higher pre-sales requirements, more restrictive loan covenants and the like. And of course, many borrowers in the property development sector have been confronted by wider interest rate spreads over benchmark rates. Credit conditions have eased a little since the second half of last year as the global financial system has gradually begun to heal, but nonetheless the volume of bank credit outstanding to construction businesses is, on APRA and Reserve Bank figures, down some 11% from its peak before the onset of the financial crisis, and that's a larger decline than for any sector except manufacturing. Development finance is typically supplied on terms that reflect perceptions of risk and return, and these will differ for different parts of the development pipeline and for different financing structures. Medium and high density housing is seen by financiers typically as more risky than traditional low density suburban developments. Construction's typically more risky than long-term ownership of the completed product, and it's typically financed in a different mixture of debt and equity. Moreover, these perceptions can change gradually over time, as occurred during the years before the onset of the financial crisis, when arguably risk was being underpriced, or they can change abruptly, as during the financial crisis itself, as a result of which risk has become and remains very conservatively priced. In this more conservative risk environment, the extent to which development finance can be structured to reflect the wider context of particular projects, including placemaking in the sense intended by this series, will depend even more than before on the confidence that investors and lenders have that the purported benefits of delivering more than just buildings can be monetised. That is, that they'll add to expected rates of return or reduce the risks associated with particular projects. And I think it can be achieved if it can be demonstrated that this approach meets people's needs for accommodation, participation in the labour market and interaction with other people in ways to which they themselves can ascribe some kind of tangible value. Or alternatively, if it can be demonstrated that the placemaking approach to development will reduce the risk that the value of specific projects will be eroded by poorly conceived or incompatible adjacent developments later on as sites are brought to the completed stage. And this could serve as the basis for ongoing dialogue among planners, developers and others, and financiers, equity and debt financiers. The Grattan Institute, with which I work, has a cities program that's run by my colleague Jane Frances Kelly, and last month the cities program released its first report entitled The Cities We Need. Development and market design is one of the three research priorities that program's identified, along with urban decision-making arrangements and social interaction within our cities. This research agenda presumes that there will be, as there is at the moment, a mismatch between the location and type of housing that Australians need and want and what's being supplied. Australians do, of course, want freedom of choice about how and where to live, but it's also important that property markets reflect the full range of pros and cons of different types of development and are responding to changing demand for different types of housing. So this Grattan project's going to examine over the next few months the regulatory, taxation and cost frameworks facing developers and how they affect development trends. It'll seek to identify any market failures in current arrangements and opportunities for markets to deliver the range of development sought by a changing population. So in that sense, Leon, so watch this space.
Okay. Okay, well, thank you very much. Our next speaker is Russell Whaley. Now, Russell is the Vice